This analysis report is on Iris Energy, or IERN, and it argues that a recent 11.5% pop to nearly $40 is the start of a huge reversal.
A reversal driven by its pivot into high-performance computing and AI infrastructure, with targets all the way up to the old high of around $76.
And I have to say, the energy in this analysis is fantastic. It captures that thrill, when a stock just explodes.
It really does. It frames it as the beginning of something big, a real re-rating, not just a one-day wonder. The dual focus on the fundamental AI story and the technical breakout is definitely the core strength.
That conviction just jumps off the page. It's infectious.
It is, but, and there's always a but, when you're talking about an 11% rocket launch in one day, the argument has to be, bulletproof.
It needs to hold up under scrutiny.
Exactly. So let's dive into that.
Let's start with the fundamental core of the argument. The report highlights and I'm quoting, unheard of PE of about 23 for a company with 355% year-over-year revenue growth.
Right, and it frames the plan for 140,000 GPUs as this pure infrastructure play. It paints a really powerful picture.
Of massive misalignment. Growth here, valuation way down here.
Yes, and that gap is compelling. But when a company is in such a heavy transition, moving from Bitcoin mining to the bleeding edge of AI, the details on those metrics have to be perfect.
Okay, so that brings us to our first point.
The crucial fundamental argument, resting on the company's PE ratio and massive GPU target, requires increased specificity to maximize its persuasive power.
It sounds a bit granular, but you're saying in a high-conviction piece like this, you can't be vague.
You can't. The weakness right now is that the analysis just throws out a PE of 23 like it's a universal number. It doesn't contextualize which PE.
You mean is it trailing 12 months, or is it a forward PE?
Exactly. Is it based on the old Bitcoin revenue, or is it trying to project future AI earnings? Because the difference there is it's everything when you're making a call this bullish.
That's a huge point. If you use a TTM PE, when the whole story is about a massive forward pivot, you're kind of misrepresenting how cheap the stock really is.
You're misrepresenting its future potential. Yeah, and that uncertainty just weakens the whole foundation.
And what about the GPUs?
Well, that's the other part of it. The plan to acquire 140,000 GPUs is presented as this unqualified positive.
But the financial implications, they're completely missing.
The cost.
The cost! We're talking about capital expenditure that could easily be in the billions. Where is the money coming from? Sourcing, deployment, financing, it's just a black box.
So a sophisticated reader immediately asks, how are they paying for this?
And the analysis provides no answer. It leaves this giant financial hole in the story. So the suggestion for improvement is pretty direct.
Let me guess. Define your metrics and talk about the cost.
Precisely. The report has to solidify its claims, anticipate that reader's skepticism.
So for a concrete example, instead of just saying the PE is 23, you clarify. Say the PE is 23 on a trailing basis, which dramatically undervalues the forward-looking AI business and is the core reason a re-rating is imminent. That frames it properly.
And for the GPUs, you have to address the elephant in the room.
You do. You don't need a full prospectus, but you need a nod to the financing.
Something like what?
You could add a line. Something like, this expansion will likely be funded through a mix of strategic vendor financing and existing cash reserves, leveraging the strong 355% YOY revenue growth to secure favorable terms.
Something that shows you've thought through the how.
Yes. It shows the AI pivot is grounded in financial reality, not just, a dream. And that makes the whole argument much, much stronger.
Okay, so that's the fundamental piece. Now let's look at how the analysis connects that pivot to the technical price target.
Right, the jump to the forecast.
It moves really quickly from the GPU story to the chart, saying a close above $42 opens the path to $55, $60, and then that big one, a retest of the $76 high.
It's an ambitious technical forecast, for sure.
And the levels are well defined on the chart, I see that. But it feels like there's a missing link, doesn't it?
There is. The whole thesis is that the market is going to re-rate the stock because of AI, but the price target is just based on where the stock used to be.
Which brings us to the second point.
To elevate the technical analysis from hopeful charting to a logical prediction, the connection between the size of the massive contracts and the target price levels must be explicitly detailed.
This is really about
The so what? Why $76.87 specifically? Beyond, it was there a year ago.
Exactly. The weakness here is that the analysis just relies on old resistance levels without quantifying those massive contracts I mentioned earlier. The claim that it's heading back over $70, it lacks a valuation bridge.
If the market cap is going to almost double to get there, we need to understand the new implied value of the AI business.
Right. Is the market just supposed to forget the Bitcoin mining part and value it purely as an AI play? A jump like that needs more justification than just there's a gap on the chart and calling the risk-reward absolutely golden.
When you're telling people a high beta stock is going to double, you need to show some math, even if it's back of the envelope.
I completely agree. So the suggestion is pretty clear. Integrate some high-level valuation estimates for the AI division that actually justify those price targets.
Tie the fundamental story directly to the technical potential.
Yes, you need to translate those GPUs into future revenue. So, for a concrete example, you could provide a high-level illustration of potential recurring revenue.
You don't need a full DCF model or anything.
Not at all. Just compare the industry average revenue per GPU per year, and then multiply that across the 140,000 GPU target. Does that revenue number support a market cap that gets you to $76 a share?
It translates the asset into a credible revenue stream. It makes the target plausible.
Exactly. Or you could break down the target itself. You could say something like, our revised valuation is $50 based on the sustained crypto business, and the remaining $26 is the premium justified by the projected recurring revenue from the AI contracts.
So you're giving the reader a logical, quantifiable reason to believe in the target.
And it connects that explosive 11% move to actual future earnings potential instead of just chart history. It turns a hope into a mathematical possibility.
All right, let's shift to the tone and execution. It's very urgent, very bullish.
Extremely. The velocity is high. If you blinked, you missed it. Beta is over 4.0. That high-octane delivery definitely gets attention.
It motivates buyers, but it also comes with a big responsibility, especially around risk.
It does. Dealing with a stock this volatile is like, trying to trade while riding a roller coaster.
It's a thrill, but you need a safety harness, and this report feels like it's missing that harness.
That's a perfect way to put it, which leads to the final point.
The highly urgent and bullish style risks undermining the analysis credibility by focusing exclusively on the golden upside potential without clearly defining the explicit downside risk inherent in a highly volatile asset.
That high energy is great for engagement, but for sophisticated readers, integrity requires balance. The weakness is critical here. A beta of 4.0 means this stock moves 4 times harder than the market.
So a 1% dip in the S&P could mean a 4% drop in IREN.
Or more. And while the analysis mentions $38 as a support level to buy the dip, it never says what happens if that support breaks.
Where's the stop loss? Where's the point where the whole thesis is just wrong?
It's not there. The short squeeze warning shot could just as easily be a bull trap. By not detailing the failure points, the analysis becomes one-sided. And for an instrument this volatile, that's just not acceptable. You might alienate the very expert readers you're trying to reach.
For an experienced trader, the risk management part is often more valuable than the price target itself. They need to know the point of invalidation.
Absolutely. So to maintain that analytical integrity, the suggestion is to explicitly map out the downside, align the risk management with the aggressive volatility. The risk-reward is only golden if the risk part is actually quantified.
So instead of just celebrating the upside, you have to map the other side of the trade.
You have to define the failure scenario. For a concrete example, define that no-go zone. State clearly, if $38 fails to hold, the next major downside test is $35. A confirmed close below $35 would nullify the short squeeze warning and put the entire bullish reversal thesis in question.
That gives the reader a practical tool, something they can actually manage.
Precisely. And you should address the beta head-on. Add a line like, given the beta of 4.0, a sharp decline requires proportional risk management. This has to be a core part of the strategy, because the downside can materialize just as violently as the upside.
That kind of balanced view still lets you be bullish, but it shows you respect the reality of the market.
It tells the reader, I believe in this trade, but here is exactly where I'm wrong. That elevates the work from just a passionate prediction to a robust, actionable trading thesis.
We've covered a lot of ground today. I think the analysis delivered a really compelling, high-energy argument.
That 11% explosion in IREN is the perfect catalyst.
Absolutely. It's built on a strong fundamental pivot toward AI infrastructure. The foundation is excellent.